All right. Welcome to another episode of Millennial Money Matters with Kelly Turner
and Derek Mazzarella.
Hi, Derek. How you doing this morning?
Oh, peachy. I've had no problems whatsoever. My phone's been whisper quiet.
Whisper quiet. Why? Why would people be calling you right now?
I mean, I don't know if you noticed the market is going bananas.
Bananas.
Yeah, in a bad way though.
In a bad way.
We're like green bananas or they're going brown and rotting, and it's like, oh, I just bought these bananas, not to throw them out.
Right. Well, and it was funny. I was just talking to somebody about the like roaring 20s that we were sort of sold at the beginning of 2025. Like this was the roaring 20s. We're like out of the pandemic. Everybody's like out doing stuff, and then the economy is currently imploding, and we're actually headed towards the Great Depression.
I hope it's not the case. But that was what happened last time we had this amount of tariffs. I don't know if you know that, but last time we had this volume of tariffs was 100 years ago.
Oh, no, I didn't know that.
115, yeah. It's actually right before the Depression. We had a ton of tariffs.
Okay, so this sounds a little depressing. Speaking of depressions, I'm feeling a little depressed here.
You should.
Right?
No. Let's be a little. I mean, so the main question I've been getting asked like all the time is like, what's going on? We headed for a recession. What should I do with my portfolio? Like, I need to go all the cash. Like, do I need to hire a gun, get a gun, and put it in my basement and like have my bunker going? And that's I think what we're going to talk about today. We're going to talk about like what do we actually do?
What do we do? What's the smart moves to make in a recession? Well, and it's funny, we talk a lot on this about like how to manage your money, the different challenges millennials have, things like childcare, summer camp, and it's hard because this stuff doesn't stop, right? Like, in prior recessions and depressions, a lot of times there was one working parent, one parent staying at home. You could sort of like adjust schedules. We're now like in a 2 working parent household here where like you still got to pay for summer camp. You still got to pay for daycare. You still got to do these things, but you're worried about your money.
Yeah. Well, I mean, we should be vets by now. We've been through, we had COVID. We had the Great Recession in 2008. We had 2022, which kind of sucked, but no one really talked about, right?
Yeah, that was like the pretend one.
Yeah. And but like we should be experts. But the problem is like we've never been in this spot in our lives where, to your point, like now we have kids, we have all these other responsibilities. We're kind of really just starting to get into our higher earning income years. So there's a lot of different challenges that we had way back when we were 21 years old or just graduating college and thinking like, oh, do I just go to grad school for another year?
Yeah, right. Well, that was exactly it. That's what a lot of people did. And the other piece too then is like most of us in 2008, most millennials, your retirement, your investment portfolio, your retirement accounts, first off, had so little money in them. It didn't matter if it went down.
Yeah, it's like I had $1,000. Now it's $800.
Oh, who cares?
Like whatever.
And retirement was so far away that like, who cares? Now all of a sudden, here we are. Again, the elder millennials are like early 40s. Yeah. My Gen Xers, you're mid 40s to 50s. Like, retirement's not that far away anymore. So now you are looking at your investment accounts, your retirement accounts from a very different place.
Yeah, and you're actually seeing real dollar losses. Like the percentages are something a lot of advisors talk about. Like, hey, it's down 10%, it's down 5%, it's down 20%. But like, what did you lose? Like, did you lose 50,000? Are you down 120,000? Are you down 500,000? So like, these are real numbers, and it's like, oh my God, it took me a long time to get there, right? Yeah. And I'm sure a lot of people are freaking out. It's very normal to be emotional about this. I think the thing that we got to do is take a step back and breathe.
Okay, what am I breathing about?
Okay, well, why don't we just get into like a little bit of market history anyway, because I think it's important to give context to what we're going to talk about today.
All right, I love it. I'm here for that.
So I'm sure people have heard of bulls and bears. Are you kind of familiar with how the animal structure?
Somebody just asked me that the other day too, and I was like, I don't know, like bulls are good. Are we talking about elephants and donkeys? Like, I don't even know. Why do we use animals?
Honestly, I should have looked this up, but I have no idea why he's calling bulls and bears. But just so we know, a bear market is bad, right? So you got a bear down. Maybe that's why. And a bull market is everything's going up.
Okay, so we are not in a bull market right now.
We are certainly not in a bull market at the moment. But then they also have different things, like a correction is a 10% drop.
Okay, so we don't call that an animal. That's not like the sloth market or the bunny rabbit market.
Yeah, it's kind of like a cute little monkey or something like that. Yeah, the spider monkey market. And then a bear market is when you're down 20% or more.
Okay, where are we right now today?
Well, we are just about a bear market with the S&P. So we're about 19% down from the peak. So just so everyone knows, we're recording this on April 9th. Okay. So we had a little bit of bounce back so far today, but that can change in 20 minutes. Who knows? So we're almost touching a bear market. The NASDAQ, which is all tech companies, is past a bear market. So they've gone past the 20% marker.
Whew.
Yep. So they're bearing down. And basically, the recovery times are interesting, right? So a 10% correction, which is only half of the bear market, right? It takes 4 months on average to recover from that.
So that's not a big deal. I'm making air quotes here. That's a fluctuation.
And most people aren't aware of this, but and you may have seen advisors throw all this chart up all the time. But the average like intra-year decline, so like in the middle of a year, is about 14%. So like this happens like almost every year, basically. Yeah. But we just don't notice it because,
subtle.
It's subtle. Yeah, it's subtle. And at the end of the year, usually we're up anyway. So it's like, whatever. We had some dips. It happens. A 20% drop takes 2 years and 2 months on average to recover from.
So that's a little more painful.
Yeah, definitely some more time for sure. And just for reference, since we've already talked about the Great Recession, that was a 57% drop from the peak to the bottom. And that took 6 years to recover.
6 years. So I think that, let's pause there for a moment. That's a good perspective for a millennial who is panicking right now, that you still have more than 6 years to retirement.
Yeah, which is great. And I'll even throw you some numbers. So like I'll use SPI, which is the proxy for the S&P 500. That was at $155 a share at the peak before the market dropped. Then it dropped down to 74. Then today it's at 497. If you just told me, hey, what was that, 17 years ago, I could bought something at $155 and now it's almost 500, you'd be like,
that sounds amazing.
I will take that.
I will take that all day long.
Yeah. So, let's have a little bit of perspective. That's buying it right at the peak of the worst crash in 100 years almost.
Yeah. So that honestly, super, you said to breathe. That's like a super relieving set of numbers for me, that, right? In 17 years, which is still within my retirement zone.
Yeah.
I'm way up, but in 6 years, I'm back where I am right now. So that's not so bad.
Yeah, and that's if you haven't added any money, right?
Yeah,
so
and we're all still working.
If you're constantly throwing money in the 401k and saving your investment accounts and doing all the things you should be doing now anyway, you're buying those drops in the market consistently. And I'll get into that more later, but that just shows hey, if I just literally did nothing and just put my head in the sand, you're still going to be out ahead in the future. Perfect.
Love it.
Okay.
Here for that.
All right. So that goes to, another kind of weird stat I want to throw out about putting your head in the sand a little bit, because one of the interesting things I learned was JP Morgan had the study over the last 20 years about the 10 worst days in the market. Do you know what happened? 7 out of the 10 days, roughly, so the best days kind of followed those 10 worst days.
Oh.
So when people say, hey, I need to go to cash, blah, 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 you're probably missing out on one of those 10 best days because they follow so closely to the worst days.
Interesting. Do you have more context to why?
I do.
That
so
is?
I'll give you an example first, though.
Okay.
COVID, March 12th, second worst day on record in 20 years. March 13th, second best day. So literally the day after, we had the second worst day, and then the day after we have the second best day.
So anybody who panicked on the 12th.
Yeah, said, I went to cash, and then they lost a huge run up.
Wow. Okay.
So it's really hard to time the next best day, and they typically follow in clusters. And I think the reason is, it's probably convoluted, but there's a lot of different reasons for that, and there's a lot of algorithms now, especially that they'll just buy triggers on certain parts of the market. But people tend to rush in. The smart people tend to rush in when the market's dropping. Yeah. Right. So that's why we typically see those bounces, and sometimes it's just things that get oversold. Right. They're like, well, this is way too cheap. I should buy some.
Yeah, I should get some of that now. And again, I think super comforting, right? That staying the course. This is sort of back to the staying the course concept of things feel today on April 9th, things feel really icky.
Yeah, because today's the day the tariffs actually went into effect.
Yeah, today feels really icky, but maybe in the coming days it will feel better.
Yeah, so we may have a day in the next 2 weeks where it's up 3 or 4%. It's totally possible.
Totally possible.
Right. So that's something to keep in mind. So now let's talk about maybe, all right, what can we do in the short term? Because most people say, I got to go to cash.
Can you just tell everybody, and I know it sounds like you should know what it means, but what is go to cash?
Means I'm going to sell my investments,
Yep,
realize the losses, and then I'm going to put it either in literally a bank account. I'm going to put it maybe a high yield savings, or people I'm going to put it in a CD where I'm going to get 3% for the next 13 months. That's what to me cash means.
Cash means okay. So just full blown.
I will not lose any principal. I'm just going to put it in cash.
But you're losing taxes and other things when you're doing that.
Well, it kind of depends on what type of account you have, because you can keep it in cash, in your IRA or your 401k. They have stable value funds. So there's definitely options within your investment structure where you can just keep it in cash. Even the investment accounts have typically a cash sweep feature, which will get you maybe a couple of percentage points. Those tend to pay less, though. than a CD or something. So that's like a natural reaction where people are like, I gotta get out. And you're like, when things get better, I'm gonna start putting it back in.
Yeah.
That's what I hear all the time. But like, what does that mean for you? Do you have a metric on that? Like, is that gonna be when it's down 25, now we're down to just 20, and it's come back 5%? Like, is that, no one can tell you that answer. And that's the hardest part about this whole timing thing, is because you have to be right twice.
Yeah. Yeah. And that's, it's funny because obviously mortgage lady here, interest rates work the exact same way, that everybody wants to hit the bottom. Like, I want to lock on the best day. And we're like, everybody wants to do that.
Yeah.
We don't know
that would be
what
amazing.
day that is.
Yeah.
We don't know what day that is.
Right.
You can't, to time it is impossible. You have to use market indicators and work with professionals who know what they're doing and stuff like that to help guide you as close as we can.
Yeah.
But no one is going to time it right 100% of the time.
I mean,
you can't do it.
Yeah, there's no way you can possibly do that. And if you did, you'd have a statue outside of like Warren Buffett's office.
That's what I tell people. I'm like, people,
Yeah.
that is my line. People be like, what do you think interest rates are going to do? I'm like, in my crystal ball that Warren Buffett gave me, I would be a billionaire if I knew the answer to that
I would
question.
not be here answering your question.
Correct.
Right now.
Correct.
See ya, bye. I'm on my private island. All right. Well, I think there's some things that people's like, well, the market's still going down. And I think it's still going to go down. Because remember, like, the market is a leading indicator. So it's going to tell you what it thinks is going to happen in the future, right? So it's telling us we're probably headed to some bad times, right? So if you want to be safer but still stay invested, there's a couple things you could do. So there's something called a minimum volatility fund.
That sounds delightful. I like minimum volatility.
Yeah, and volatility just means things are going up and down pretty crazily, and these are designed to not go up and down as much. And I just want to preface this as well for the compliance folks. Like, this is a podcast. Please don't take investment advice just strictly off this. Talk to your people.
Yep.
Do your own research. Okay. But this is just some ideas to throw at you. So minimum volatility is basically say, like, look, we have a thing called like downside and upside. So like you may get 70% of the downside. So if it goes down 10, you're going down 7. Right, so it's capturing less of the downside, right? So you're losing less. But usually the trade-off there with these funds is on the upside, you're going to get like maybe say 70 or 75% of the upside, right? But for a lot of people, especially like our Gen Xers that are closer to retirement but not in retirement, these can be good tools because they're saying, okay, well, like I'm going to still capture some of the market, not all of the downside. I'm going to lose less. And for a lot of people, that's more important than getting, more gains. So that's an option. 2 is bond funds. Hey, they're still there.
Us mortgage people would love for you to get into bonds right now.
Yeah, and the challenge is, the challenge we had in 2022 was like bonds and stocks went down at the same time.
Yeah.
So far, they've seemed to hold. That could always change. We've seen little chinks in the armor with that one too. But one of the ways around that too, instead of just doing bond funds, you can do what's called laddering, right? So bonds have what's called maturity dates. So bonds may mature as quickly as 30 days or as long as 30 years.
Oh, so you're again timing things, but depending on how long it takes, you're looking at something different.
Yeah, but what a ladder does is okay, we're gonna buy bonds at different intervals. So some are gonna come due in 30 days, some are gonna turn in 90, some are gonna come due in a year and a half. So like you kind of build this like portfolio that's kind of constantly coming due, and you just kind of tack that new one that covers on the back of the line, right? So you're gonna have this thing.
So you're kind of hitting the market gains and dips as
yeah,
you
so
go.
it'll help reduce a little bit of volatility for you, first of all, so the ups and downs of the market, but also like there's reinvestment risk and interest rate risk. So if the interest rates are constantly changing too much, then you're kind of buying different ladders in different areas of the spectrum.
That's kind of cool. I didn't even know that was a thing.
Typically much better for retirees, but that's an option too. And the other part is there's defensive sectors of the market. So there's things that like you're always going to go and buy food.
Yeah.
Right. You're like, I'm not going to give that up, but you may give up traveling. You may give up getting your haircut done as often. Like things like that, like that's called discretionary.
Yeah, so the Carnival cruise may not be the greatest investment right now, but like Nestle might be.
Yeah, so generally, yeah, in down markets, like utilities do well, the staples do well, things like that. Healthcare, usually you're having a heart attack, you're like, well, I'm gonna wait this recession out.
Yeah, all right, I'm good. I'm good for the moment.
Yeah, no, we can pause on this. So those are the 3 areas where typically, if you want to stay invested, maybe just shift some of your portfolio away from tech, away from those like Carnival cruises. Sorry, Carnival, we love you. To those types of things.
I'm a Royal Caribbean girl.
Yeah. Oh, all right.
Fancy.
Yeah, I guess so. So those are kind of like the 3 core things you could do, like where you're making tweaks to your portfolio without just like saying, oh my God, I'm going to blow this up. Like the analogy I use, because, big on analogies, is like if you're redoing, like you're looking at your kitchen, you say, all right, do I just maybe change some stall stuff, like change the curtains? or do I revamp the whole kitchen?
Yeah, am I demoing my cabinets, or I'm just giving everything a little facelift?
Yeah, maybe just a little painting, right?
Facelift.
Let's facelift it.
Let's talk about cash again really quick.
Okay.
Is there anyone who should be going to cash?
Yeah, so I think you're typically going to find yourself in two spots in this market, right? You're either about to retire or you are retired. And that's where cash can be incredibly useful because I kind of mentioned that, the bear market 20% drop 2-year thing. Generally for clients, I recommend keeping 2 years in cash that are retired or about to retire because it gives you the time frame to weather this market. Because the challenge is in retirement, you're going to have other challenges. You're going to have inflation to worry about. You're going to have medical costs going up and things like that. So you need the market. You need to be invested in stock to have that outpace that part of it. So this kind of creates a balance. So I usually do what's called a bucket strategy where you have 2 years in cash. You have 3 to 6 years or so in like growth and really quality companies. And then you have the last remaining bucket. That's going to be your growth bucket. So this is where cash can be a really useful tool to those retirees or people about to retire. Because if you're retiring into a down market, that's also a real challenge too.
Yeah. And when we're talking about cash, guys, again, we've said this in other episodes. We're not talking about stacks of cash under your mattress. Please do not do that.
So high yield savings accounts are good. You want to get some interest on it if you can. CDs are fine. Just make sure you're timing up correctly with when you need the money.
Yep.
Like you need to give your money a job to do. So it should be there to do the job.
Love it.
Okay. So if you're retired, that's what you really want to do. The other thing you can look at is, there's some annuities that pay, income and, the retirees that have told me they, especially in 2022 when stocks and bonds aren't working, they're getting the same check every single month, right? So when the market drops, same check. When the market goes up, same check, right? So that's something where you want to say, okay, between Social Security, if I have a pension, good luck if you have that. If not, this is where an annuity can come in and fill that gap because you want to have your fixed expenses
always covered. Yeah.
So you can do that with a combination of Social Security, pension, or an annuity, or some combination of the three. Because then hey, no matter what, I'm good. I can go to the grocery store. I got this. I got my stuff covered.
Your prescription meds can be paid for.
Yeah.
Your Dunkin' Donuts, whatever it is that you need.
Yeah, because a lot of this is honestly behavioral. Because if all you have is the market and the market's going down and stocks and bonds are going down, you're going to freak out. Right. And then you're going to go to cash. And then you're like, oh, now I missed the 7 best days in the market because I was in cash and I was too late to come back. And now I'm already in a hole behind. It's like trying to catch up in a race by going slower. It's not going to happen.
Yeah.
So you having these things in place is about keeping the plan together. And that's one of the common themes I've had because I've been taking a ton of calls the last 2 weeks. The first thing I've said is look, we're still on track for your plan. That's the most important thing.
Do people just go when you say that?
Oh, good. Okay.
All right.
I had a meeting yesterday. I was like, look, let's say it drops 20% from here. What happens? Still good. Oh, okay, great.
Yeah, you're just don't. I'm currently my strategy is I'm just not opening any of the websites. I'm just not going to look at them right now because I'm young and I have time.
You have time. Don't worry about it. So let's say you are younger, and I know you are obviously very youthful.
I'm going to be 42 at the end of the month. Very youthful.
Okay, so you're in the accumulation phase, we call it. There's a few things you could do. Because right now stocks are on sale. We have the only profession where people are like, oh my God, these jeans are on sale. I'm going to wait till they're double the price. No one goes into a Target and says, wait, 20% off?
No thanks. I'm good.
I'm good. I'll wait till they're more expensive because they must be more valuable and better, right?
Right.
We, for whatever reason, we do this with stocks. If they're going down, we just assume they're naturally going to keep going down forever. And if they're going up, they're only going to go up forever.
Going up.
Right. So for us and anyone younger, this is a huge sale opportunity. Now, that doesn't mean throw all your money in right this second. What you could do is you can kind of dollar cost average of it because, this may go on for a little bit of time. And if that's the case, then you would want to chunk money in over time. But if you're already contributing, let's say 5%, can you squeeze in 7? Can you do 8% in your 401k? So those are the kind of things you want to look at in terms of adding money in over time. Next is tax loss harvesting. Have you ever heard of that? Fancy concept.
Yes, I have from you. Tell me more.
All right. So let's say I bought Apple stock. Apple's getting rocked, right? I'm just going to use round numbers for easy math here. Let's say you bought it at $100 and now it's down to $50.
Oof.
So you lost half of your money there, right? You can say, okay, I'm going to sell it now at $50. I'm going to get $50 in losses that I can then carry off into use against future gains, or I can offset up to $3,000 a year of income every year. And you can roll that over. So if I have $10,000 of losses, I can offset $3,000 a year of income. And if you're making really a lot of money, you're at 30+% tax bracket, you're offsetting 30+% of your taxes.
Wow.
So it's a useful tool. Plus, for the interim, it could keep your money out of the market for 30 days, which, if it is timed correctly, could work. because you can't sell it and then buy it back the next day. You do have to wait 30 days.
Okay, that was going to be my question. Can like if it's $50, can I sell it and then just?
But you can do that with crypto. I didn't say that here, but you can do that with crypto.
We don't talk about that.
Yeah. So that's a definitely tool. You don't have to, necessarily. You can't buy Apple again, but you could buy a different company.
That's also low. Yeah.
Yeah. So if you wanted to sell your Apple, but then buy Coca-Cola, like it can't be like. Basically. So that's just something to watch out for. So that's a way to take advantage of the losses now, especially if you have some time and you're in a higher income bracket. That can be really useful. The third thing is Roth conversions.
There's so many like weird words in investing. Tell me more about a Roth conversion.
All right, yeah, I know, very sexy. Well, this is all about tax planning. So a lot of this stuff is taking advantage of laws. But basically, to recap, if you guys haven't missed one episode, we did an episode a while back about like what the tax treatments of things were. But basically, you have money in an account that's called the traditional IRA. It basically has not been taxed yet. You got your tax deduction when you first put the money in there, but you're going to pay taxes later.
Yep.
What a Roth conversion will do is that you can actually take that money, convert whatever amount you want to, pay the tax on that amount you convert, and then now you can make it a Roth, which means all the future gains will be tax-free. Right? So there's a couple ways this is beneficial, right? So one, any advisor is going to say, wait the market out. So you're going to okay, so you're going to let it go down and then come back up in value. Now, if you convert it into Roth, all that come back in value is now tax-free. Right? So that's a nice feature.
That's very nice.
But also, okay, now let's say my account was 20,000 and now it's down to 15. All right, now I convert to 15. I'm paying taxes only on the 15, not the full 20.
Oh.
Right, so now you have an opportunity to say, okay, I've got a dip. I'm going to take advantage of this lower tax or lowest amount from a tax standpoint. Now I'm converting it. Now all the future growth is tax-free. So this is an area where you want to pay attention to your income bracket and where you'll be in later. But if you're a lower bracket now, especially for the younger folks, this is going to be a really good opportunity to say, hey, look, I'm going to pay some taxes now. I've got some room under my bracket. And I've got 30 years to go. I'm going to have 30 years of tax-free growth on this account.
Now, when we hear taxes, I think the average person thinks like, oh, I talked to my accountant about taxes. I talked to my CPA about taxes. But this is a financial advisor conversation.
It should be both, honestly. But the challenge I see with a lot of accountants is they're typically just looking 1 year back. Right? So they could tell you exactly where you are today. The challenge is, and no one can do this in exact science because I don't know where tax rates are going to be. But you can say, hey, look, I know in retirement, I'm going to make way more money, blah, 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 whatever. I could be in a higher tax bracket then. So that's where having that math and kind of figuring out, okay, does it make some sense to do that? And a lot of times I see this makes sense for people that really just don't have a lot of Roth dollars or maybe making too much money. They don't have the ability to add to Roth directly because they make too much. So that's where that tool can really be helpful and saying, okay, look, this could be an opportunity for us to drop down, take advantage of this dip, convert it, and then we pay no taxes.
No taxes.
See you later, Uncle Sam.
Amazing.
Yeah, because if you're 30, now you've got 30 years to retirement plus another 20 years of retirement, right? So now you've got 50 plus years of
no
tax.
tax. Yeah, it's just this thing is just chugging along.
Yeah, and it's actually Roths are a much better thing to pass on to your kids and stuff like that because you don't have to pay taxes on it. You have to devise them, So there's a lot of reasons to do it, but you just want to make sure you're kind of talking with your accountant and your professional about, hey, where do you think I'm going to be? Am I going to be doing because it doesn't make always sense to make converted like a 37% tax bracket either. Yeah. So that's the math you have to figure into. But yeah, those are the three main things I would say, low hanging fruit. Here's some opportunities you have within a down market.
All right. I like it. Some good advice.
Yeah. So I would just say, hey, look, if we're headed for recession, take a breath. It's going to happen. You've got time for the most part. If you don't, you should be invested correctly anyway. Yep. And one thing to note is, like I said, stocks are a leading indicator. They are going to recover before the economy does. So your stocks will go up. So when you still feel like it's bad in the economy, guess what? Your stock portfolio is going to go up.
Oh, so I don't think I ever really thought about that.
Yeah, they'll go down before the recession. Typically, happens. The recession happens, right? You feel like crap the whole time, this sucks, and then the market's going to rebound. And you're like, oh, but it still sucks. People still don't have jobs, right? So that'll happen before the economy recovers. So don't wait for the economy to recover to make these changes and tweaks.
I like it. That was some great advice.
Oh, that's what I'm here for, right?
All right.
Any other questions, Cal?
I'm trying to think. No, I don't think so. I think this was, I feel calmed by this conversation. I hope that our listeners do too. But just from the, again, I think to recap, we're young. We've got time. Yep. Don't panic. Mm-hmm. Don't make short-sighted decisions like pulling your money out. Right. And if you feel like you need to make decisions, meet with your trusty professionals to come up with a plan that makes the most sense for you.
Yeah, because this is all comes down to you anyway. So like some advice I said today totally wouldn't apply to you.
Yep.
Right. Some stuff may. I have no idea. Right? I don't know you.
Somebody's got to look at
Yeah,
your
yeah. Someone's gotta look
full
at it.
situation and make those choices.
Right.
So,
Exactly.
so awesome. So
Well, hopefully this was helpful.
not the roaring 20s that we were hoping for, but
No.
here we are. So let's make the best of it.
Well, hopefully we won't have any breadlines in our future. That's really
I
gonna
know,
be it,
right? No, I would love that too. I would love that too. I am making a moonshine in my basement though.
Yeah. Well, maybe this is the rebirth of the sourdough thing, like we had in COVID, where everyone's just like,
yeah.
I'm going to start, my own garden and sourdoughing it.
I never sourdough'd, I will tell you. That did not happen for me. And it's funny because I love to bake, but
Yeah.
it just wasn't, that was not my flavor of COVID.
Same here. We had a friend doing it. I'm like, you have to do what? You have to feed this thing?
Every day. It's like a lot of work.
Yeah.
Yeah. I was busy closing mortgages during the pandemic because it was, the busiest the mortgage industry had ever been. So I had
Yeah,
no
you were-
time for COVID hobbies. Now actually is
Now it's great.
when maybe I will start sourdough.
Okay.
Does anybody have a sourdough starter that they want to give me a piece of? Let's see if we
Yeah,
can
let
make
me
sourdough happen.
All right. There you go. All right. Sourdoughs and stocks. Let's do it.
All right. Have a good one.
Bye.